What's going on, guys? Hey, everybody.
What is going on, people? Hope you're all enjoying this beautiful Sunday, the first weekend of spring. And today we are actually going to be talking about, obviously, following up with our video we just dropped this week. And our video is on buying real estate in 2021, what you should be aware of, some things you should think about. You know, we are in a seller's market, so people are going ridiculously amounts over asking. So, we want to talk about, mortgage things. We want to talk about some lawyer things in regards to how can you protect yourself. So we wanted to bring Shawn Quigg on here. Hey, what's going on, everybody? Here goes Shawn.
Hey, guys. All right.
Good, buddy. How are you?
Awesome. Thanks for having me on again.
Yeah, thanks for coming on. So, we're actually on Instagram and on YouTube and on Facebook. So for everybody who's on our Instagram channel right now, if you guys want to swing over and see Shawn, if not, you can hear him, but we are going to be streaming the video portion on YouTube and on Facebook.
Yeah,
man. So how's things? What's going on?
Well, as you guys are, I'm sure, aware, it is a busy time of year for us in the real estate investing business.
It is.
Quite aware, my friend. It's pretty busy, dude.
We are slammed at Carson Law, working with investors, with business owners, and Ryan and I love doing it. We love working with investors, and we do so every day. We are investors, as you both know, and so we are very busy. I just finished some work up probably for the rest of the night, and then I'll be back at it probably very early morning tomorrow.
Yeah, no, we feel that the volume of transactions that are happening right now are quite unprecedented. I mean, I remember obviously 2017, there was kind of something like this where everybody was just buying houses and there was a little bit of FOMO involved and people were kind of wanting to get in as soon as possible because houses prices were never going to be that price ever again. So,
Right.
So we wanted to create a video because we had a lot of questions. We had a lot of people who were wondering essentially how to make a competitive offer or what to look out for when making a competitive offer in the market. So we wanted to touch on, a handful of things just on the liability side, on being, aggressive and actually getting the deal you want to get side. So we decided to create that video. One of the things that we decided we were going to talk about first was the current climate. So as a lawyer, tell us about how somebody should approach, purchasing property in this kind of, climate where everybody's making purchases over ask.
Well, the big thing for me is confidence. And that's not necessarily confidence in yourself, because we all need to, especially in times like these, sometimes take a step out of our comfort zone. But what I'm talking about is comfort and confidence in your power team. So this means having pre-existing relationships set up with a mortgage broker like the two of you, with your accountant, with your real estate agent, with your lawyer, so that when it comes time to make a snap decision, you have confidence moving in and actually making that offer to the point where you can be confident that it won't be one of your power team members that lets you down if the deal isn't able to go through.
For sure. I mean, having everybody on the same page and everybody just knowing your current situation and what you need to do and being able to work together, communication is key in between those people, because without communication, your deal is unfortunately going to have bumps along the way. So if you make sure everybody is on the same page and knows everybody, or at least knows who they're dealing with, like if my team knows the law clerk who's doing your deal, that communication always goes smoothly, and then communication to the lawyer goes smoothly, then your deal kind of flows in a certain way. So it's definitely important to be able to set that up prior to committing to transactions.
It's so important. And I'll give you a couple of examples about why not having your proverbial ducks in a row can hurt you when it comes to crunch time. And a topic we often get asked about, and I'm sure the both of you do as well, about whether to hold real estate assets in a corporation. And there are pros and cons to doing that. As a lawyer, I'm always going to recommend that you do so. but I'm looking at a liability side, and I tell my clients this is a three-sided conversation, right, with your lawyer, your accountant, and your mortgage broker. And
Sure.
the reason why I say mortgage broker is because recently, in the last 2 weeks, I've had two deals almost fall through because not enough due diligence or understanding was there on the part of the buyer about what it means to have to purchase real estate in a corporation.
Mm-hmm.
Had those conversations, had attention been paid to those conversations in advance of the problems arising, we could have avoided them. But instead, some choices were made where it didn't, in the end, it reflected that these particular buyers just didn't have a full grasp, a full understanding of what it means to buy real estate in a corporation. And so this is what I say, or this is what I mean rather, when I say you got to have confidence in your power team, and you got to listen to them. We're all here trying to make a difference in the lives of others. We work to help others. The two of you do it, I do it. All of us at Carson Law and all of us at the Finley Mortgage team help you guys. And so, if there's advice to be given, then that's advice that should be had.
Mm-hmm. Yeah, and holding companies, they cause such little issues on the residential side too. Not a whole lot of companies like lenders are accepting purchases on the residential side and then the holding company, and if they do, there's some limitations and whatnot when looking at the underwriting guidelines. So it's not always guaranteed that you can purchase residential real estate in a holding company, even though it seems like it's so prevalent and you probably hear about it quite often. It's not as easy as it seems. There are some hiccups that can come up, and I think we just did a video on this too that should be coming out in the next week or so about doing in a holding company. The biggest thing that I want to point out from our side is just that the holding company can't be an operating company. So I had a client where they Googled the holding company name. It sounded like a business name. There was some stuff attached to it that made it sound like a business name, and the lender Googled it and they traced it back to like an actual company, and the company had some stuff, and they're like, this doesn't work. Like, this is an operating company, whether they're generating revenue or not. I mean, they're like the way that they're utilizing this. Excuse me, this is an operating company, so they ended up canceling the deal for a couple other reasons too, but mainly because they were trying to get it done in that company just wasn't deemed an actual holdco as operating. So if there's any sort of business generation of and business generating income on that company, they're probably going to look at it as an operating and not the holding. So could be some issues.
Yeah, holding companies are interesting because a lot of our clients approach us saying, "Hey, look, I want to get a holding company." They don't understand. As you said, they don't understand why you want a holding company. Like, do you just want one because you want your real estate in there? Like, why do you want it? And what are the ramifications of having that? And, what are the yearly costs of having it? What do you have to do? What are the requirements? Why would you want that? How's it going to help you? Like, there's so many different factors that would go into somebody choosing to use that specific tool in their real estate investing portfolio. And just, it's not always the best case. And it sometimes might hinder you in moving forward if you are using it that way. So again, as Shawn said, great thing to know is have your power team just set up to understand and to advise you correctly, because that might be a step in the process, just maybe not right now. Like, it might be something down the line. If you're purchasing multifamily real estate, 100%, get a holding corporation, put it in the holding corporation. That makes sense. But there are definitely situations where you probably shouldn't be purchasing real estate in a holding corporation. One of the things we also want to talk about was what the current climate is at the moment. So, there's bully offers. So when someone's putting an offer in right now, people are going in, no conditions, over asking. And what does that mean for lending? So how does that affect somebody if they want to put an offer in a property? Well, you need to be pretty bang on with your numbers. So you have to know either you have bank of mom and dad somewhere, or you have a decent amount of liquidity in your bank account to be able to make offers like these. And a lot of people, unfortunately, are being pressured by their realtors, being told you'll never get into a property if you don't go no conditions. And I don't think people quite understand the legal liability that comes with it. Because at the end of the day, if you don't have that money and the value comes in less, you can't help them. I can't help them. There quite literally is very few things that you can do in a situation like that.
Mm-hmm. And especially just, not only making sure the numbers are good, but making sure the cash is there too. If you go a pretty hefty over asking and you end up getting that and that appraisal doesn't come in, that overage of the asking price is going to be covered in cash. So I haven't seen it too often with any of our deals. I think I've only had one deal in the last 7-8 months that's had that problem, but that there's always a chance with that and it coming in, and the client had to pay $55,000 out of pocket, and that $55,000, that's a down payment moving on to the next property. So it can shut down your real estate purchasing abilities really quickly when your next down payment just went to the down payment on your current home.
Especially when the current valuations of houses are moving up so quickly and appreciating so fast that if you at 7% month, banks aren't automatically going to be like, oh yeah, that makes sense. Like that is what it's worth. Like I've had clients who their appraisals came in at value because the comp supported it, but the bank's like, not a chance. Like there's no way. And a big five bank. It's like, no,
Scotia's been really bad for it apparently.
Yes, just mitigating risk by just being like, no, we're not comfortable with the valuation. It's gone up too fast, too quick. Sorry. It's
it might be time to get creative when that happens, right? So, as you guys say, there's not a lot that we can do once you go firm on a deal. We can try, and we've been successful in the past trying to negotiate out of these deals. I'm set to do one on Monday. Now, luckily, that one has a little more teeth to it, even though it is firm. But it's pretty challenging, and frankly, as a buyer, you should be concerned about this. Now, there are a couple of reasons, and do not, for anyone who's watching this, do not take this as advice to go out and start going firm right away, because I can't possibly recommend that you go firm. But when we're talking about legal liability, when it comes to breaching an agreement of purchase and sale for a real estate asset, there's a certain set of things that occurs or needs to occur before a court will take a look at that breach and say, yeah, hey, Mr. or Mrs. Buyer, you breached the terms by failing to close, and as a result, you're liable. So number one, the buying lawyer is going to do something called tendering. What that means is they show evidence that they were ready, that their client rather was ready, willing, and able to close. Now that's really easy to do as a seller because you're not really doing anything except delivering keys and a set of closing documents. Pretty seamless when you're talking on the seller side. And so once the lawyer does that, once the buying or the selling lawyer does that, then that's called tendering. And once someone is tendered, this is sort of like the setup play to a lawsuit. So right after that, they consider the contract as being over at that point and breached, over because of the breach. And so what happens then is the seller then has to go relist the property or put it up for sale in a private network. They somehow have to show that they're putting the property back on the market. And the reason they have to do that is because in law generally, when it comes to lawsuits, and real estate is no different, the seller has to prove that they suffered a loss. And this is where, in a market like this, there's a tiny bit of insurance left there for the buyer. And that's because that seller has to put that property back up. And in a market where houses are appreciating X% a month, the chances of the seller selling for an amount less than what you agreed to pay for is a little bit lower.
Very interesting.
It's pretty low, in fact. And so this is not advice to go in and start making firm offers. But you should be speaking with your real estate lawyer and your real estate power team to make sure you fully understand the consequences of going firm. And you guys spoke about this in your latest video with Matt on Matt's channel that came out this week. you've really got to understand what you're doing when you go firm. And so that's why people like yourselves, people like me, that's why we are set up and ready to have conversations with buyers who are ready to go firm. Mm-hmm. And why it's so important to understand what going firm means.
100%. Yeah, I think the biggest thing that, you know, from our standpoint that we want buyers to know is that there is no point throughout the mortgage process where, like, going firm doesn't necessarily mean, you know, going firm means like that's it. Like, you're going firm on the deal. Obviously, there is no safety protocol once you get the approval, right? Like, once you get the approval and the commitment letter from the lender, that is often the point in which you have to make the decision to go firm, because you're going to end up signing the commitment. But that does not mean once you sign the commitment that, you know, you're good to go. The lenders put the money on the money on the paper and you're good to go. Like, it's still conditional. You know, the lender can cancel that deal up into the day of closing, and we've seen it happen. If for some reason you fail to meet any of the conditions throughout that period, the lender does not have to go through with the financing. And like I said, we've had deals where the day before the employment check did not come through, and the lender pulled out, and you have to close privately. So there is no standpoint, for the record, there is no point in which you are 100% good to go, other than when we get, a call from the lender and their broker complete on our end and our conditions are satisfied. Now we're good to go, and it's just on the solicitor or the lawyer to finish up their side of the conditioning and make sure things are good to go. But there is no point at which we can confidently say, yeah, you're good to go firm. That's a decision the buyer has to make and make on their own.
Yeah, and like there's risk when you go firm. If you're not able to close for some reason, you could be on the hook. And even if that seller goes and relists the property and sells it for $40,000 more than you were willing to purchase for, well, that's fine. They may not have suffered a loss on the purchase price, but they may very well have suffered additional costs. And those costs might not even have a cap to them at this point, given the amount of legal and accounting and mortgage work that goes into having to cancel a deal.
Oh, yeah.
And so, if you're a buyer and you're finding yourself in a position where you've gone firm and your financing falls through, well, it's time to get creative. And I actually had clients that had this exact thing happen between the time of waiving conditions and closing. And that was the appraisal came in much lower than what they were expecting. Mm-hmm. And so what did they do? They had to get creative. And even though they're newer investors, man, they did a pretty good job. They reached out to a mutual client of ours, a lending client, who is awesome, and found a way to make private money work so that they could close without breaching. And then their plan is to turn around and put it right back on the market with a realtor, with a proper sort of selling package to the market, not necessarily to investors, but to the market at large. And we'll try and take advantage of
that market,
increasing market, and the fact that we are seeing, single to double digit appreciation on a monthly basis. Mm-hmm. And so that's what they're doing. And are they going to do as well as they wanted? No. Are they going to profit? Maybe, maybe not. But their loss will be much lower. And this is a great example of why being creative is so important. So important of a skill set in this business. If they offered to pay much higher than the appraisal came back at, and so if that seller put it back on the market and that seller got the appraised price from some other party, well, then the difference, the spread between what my clients were willing to pay and what that appraisal says, that's the loss, right? That might have been $50,000, $60,000, and that's a bona fide case. Like, that's a loss that's suffered by the seller, and it's going to be hard to walk into court and say, well, no, they didn't actually suffer that loss, because it's all documented. Multiple professionals are involved, multiple professionals who deal in trust, and so, yeah, it's time to get creative if you go firm and you're not able to close.
For sure. And there's a ton of creative ways to be able to, fix situations. We have clients come to us all the time in these situations, and there's definitely ways to be able to, get into properties or to fix certain problems, depending on how much equity or how much cash you have. Or obviously, unfortunately, the more creative it gets, the more expensive it gets the majority of the time. But there are solutions available.
Yeah, private markets is literally just essentially you're buying your solution, and the better the solution you need, the more expensive it's going to be. And we can pretty much find solutions for any situation. It's just how much money do you want to spend, and does it make sense to spend the amount of money you need to on a private, or what does it look like on the other direction, and just essentially what's going to cost you less in the long run. If it's going to be 1.5 times the cost that it's going to cost you to go through some sort of legal action, that hey, play the numbers. We'll figure it out for you, and we can put together the options, and figure out what's the right scenario to go. Now, I have a question for you too on the flip side, because I think we've actually seen it a couple times where the buyer's been all ready to go, but the seller, who maybe this was initially earlier on the market, now realizes how hot the market has become, and no longer wants to sell their property at the same price. They think they want to, kind of renege on the accepted offer, and thinks, hey, I should be getting additional $30,000-$40,000 for this building. Have you seen much of that happening lately, or?
We've seen hints of it. We've seen sellers, try, but ultimately I haven't seen a seller breach an agreement because they wanted to go put it back on the market to get more. And there are consequences. It's a little bit tougher in this scenario because, unlike on the flip side where you have a documented loss that you can show easily, it's really tough to show a loss on the part of the buyer when the seller breaches the agreement. So unless you can show that you, as the buyer, were purchasing a property that only that, like, the unique characteristics of that particular property were so unique and so valuable to you, and you could actually prove that value and prove that uniqueness, then you might have a claim for an equitable relief called specific performance, and that would be where the court would actually force the seller to close the deal with you. But otherwise, you're looking at monetary damages. Well, how do you prove monetary damages in a case like this? How do you know, if this is a BRRRR project, how do you know what the repairs are going to cost, and how do you know what the refinance is going to be? And do you even want to tell the court that you're going to refinance and decrease the amount of money you have into the project? Is it a flip? If it's a flip, maybe then you might have a little bit of a better idea, because you could say, well, this is what I would have done. I had this appraisal done in advance to show what the approximate value would be at the after repair value. And then you might have some damages you could prove. But it's much more forward looking and guesswork, as opposed to the flip side, where it's the complete opposite, where it's looking in reverse at an actual loss suffered.
Mm-hmm. Yeah, no, I had a client call me. So this is a somebody who's a wholesaler, and they were saying how they had a firm deal. It was a pretty sweet deal, and I guess this guy he had faked, or somebody had told him to go admit himself into the hospital for having mental issues, so that he could use it as a defense that he wasn't in the right mindset to be able to put the house in the market.
Oh, man.
He was gonna take like a few $100,000 loss, and maybe he had to be there. I don't know, but it was an interesting story. People are coming up with some ways to get out of firm sales.
Yeah, I guess you do what you got to do, but no one watching this should take.
No, definitely not. No. It was just a funny story that somebody told me.
Do not admit yourself to get out of a deal. It's not the right way to get around it.
Just some crazy stuff happening in this market. That's all.
Yeah. That's a unique strategy, or maybe I don't know. I've never seen it deployed, but my goodness,
that's not advice, guys.
I got a quick question here from Josh. With the appraisal being so important, is it possible to get one done before submitting the offer? So it's definitely possible. That's not the problem. The problem just comes down to, each lender has their own sets of appraisers that they want to work with, and there is no guarantee that we can use that appraisal that you've ordered beforehand. So, if you want to get one done for your own personal knowledge, and maybe you're thinking of doing a refinance or something, and you just want to know, hey, where's my property going to come in at? I want to figure out how much equity I'm going to have for the next purchase. By all means, you can definitely get your own appraiser, your appraisal, order it yourself. There's just no guarantee that it's going to be able to be used for the actual deal once we get it submitted in. So
also the odds of a seller letting you or have somebody else go into their house without having an offer or a firm offer is probably low. I mean, why would they have somebody or allow somebody to be able to go into their house if they don't have an offer in place?
Yeah.
You could do it on one of your walkthroughs.
Sure. Yeah.
You could bring the appraiser with you, I guess. Yeah, do it. Get a figure of value.
You wouldn't necessarily want to pay for an appraisal before you have a property under contract.
Yeah.
You could rip an appraiser through with your inspector or with any sort of walkthrough. An appraiser doesn't need much more than 15 to 30 minutes in a house, depending on the type of property. You get a sense of what they're dealing with. At the same time, though, you guys are absolutely right. That appraisal report is not necessarily going to be used by the lender later on.
Yep. Yeah, it's tough. I mean, with the way that we underwrite our deals, we ask for all of our documentation and stuff up front, and it's specifically due to the conditions that come in on a commitment. We try to eliminate and verify as many conditions as we can up front before submitting the deal so that we eliminate any chances of surprises down the road. The biggest thing that we can't, figure out ahead of time is the appraisal. And I just had a deal that got canceled by the lender. Again, came down to the appraisal. It was a off-market pickup. It structurally sound. The building, wasn't very many issues. It did come back on the appraisal that the roof was in immediate need of repair. So unfortunately, that wasn't really about to fly with the lender. Now, typically, they might just do a holdback or something like that on closing. But the big thing with this was that the other unit just wasn't in great visual appearance. Structurally, it was fine, but the tenant was a bit of a mess, and it would very much look like a bit of a hoarder's unit. There was just a lot of stuff piled up everywhere, junk on the floor, like just no real room to move around. And that in conjunction with just the roof, the lender didn't feel comfortable putting the money out on it and canceled the deal. We do our best to figure out if a deal looks like it's going to fit the general underwriting guidelines of that lender. And, we can say, hey, yeah, I've seen buildings like this going for, 80% loan to value, or, hey, maybe we only see them going for 75% loan to value. But, how we submit the offer, the lender has the final say based on all the conditions and the documents associated to those conditions. So, just because you get a commitment with something that says 80% loan to value, once that appraisal comes in, that it doesn't guarantee that the lender can't change that loan to value and drop it to 75 or 70 because they see some issues with the property and they want to decrease their risk on it. So it's a tough situation, and it can definitely leave a little bit of a sour taste on a deal because in a busy market, these guys were supposed to close on the 25th and we found out on Friday. So it's a tight timeline, but it's something just to be prepared of and understand that when you're buying these off market, undervalued, or properties that you're looking to burr, there is always that chance that the appraisal doesn't fully come through, and there can be small consequences, a $5,000 holdback, or large consequences. Your deal gets canceled, and now you got to close on it privately and get the building back into better shape. So the appraisals are a huge factor, and other than getting your own done and trying to get it done on a walkthrough, like you said, which is a pretty good idea if you can get it done like that. There is no way preemptively to figure out how that condition is going to come in.
Yeah, it's definitely a level of risk that kind of isn't really talked about because it doesn't happen a lot. We don't want to scare everybody. Just like the liability, in a market like this, we see it more often when valuations have increased exponentially over a short amount of time. More people have issues with verifying the value on properties, which brings in a little bit more risk if you were to go over asking, or you set a precedent. If you're the first one in the area to to buy a house at that value. And if an appraiser can't find another house similar to your specific house with the value you're buying it for, unfortunately, you're the first, and you're gonna bring the value up everywhere else in the neighborhood, but you're unfortunately gonna have to bite the bullet on trying to come up with that down payment.
Yeah, there's the trend setters, and then there's the trend followers. So depending on what you are, you might be following the trend and you're okay, but if you're setting the trend, you might be paying that extra overage out of pocket on the first one in the neighborhood. So just things to keep in mind,
That deal better be a very good deal, or have potential to be a very good deal to do that one.
For sure. I think one of the things I also want to talk about was your due diligence clause. I know we spoke about it last time, but a way to be able to be competitive in this market without necessarily putting in a financing clause is a due diligence clause. It gives you the ability to be able to take a look and assess the actual deal without having to raise alarms or red flags that are almost like giant flashing signs for sellers. So they may not necessarily look at due diligence the same way as they see financing as a risk.
Yeah. So the due diligence clause is sort of the all-encompassing legal condition that can really help a buyer in a market like this. Now, it's not guaranteed to help because realtors, even non-investment focused realtors, are starting to pick up on what due diligence means. And really what it means is it's a catch-all. But it has a connotation in business, right? Due diligence is where we compare what we've been told with what we've been provided to make sure that it actually matches up, so that when we enter the deal based on what we were told, we're actually still doing the very same deal, as opposed to one that's either perhaps not quite as good. So when we put in the due diligence clause, we're representing that we want to make sure that the deal we're buying matches up with the deal we're told it is. And to a certain extent, this makes sense, right? When you're looking at an MLS listing and you see, let's say we're talking about a triplex, and you see, okay, well, the tenants pay their own electricity, landlord pays the water bill in 2020 was $800, property tax was $3,000, etc. So we've been told these things, but we haven't actually been provided proof. So we put in a due diligence clause that says, you've got to provide us these documents. And when you look at the water bill and say, okay, it was $800. And we go look at the property tax bill and say, okay, it was $3,000. That's the process of due diligence. Now, the great thing about due diligence is it's a term of art. It doesn't have a true defined meaning. And so when we put a due diligence clause into an agreement of purchase and sale, anything can be due diligence. Financing can be due diligence. An inspection can be due diligence. Just about anything can be due diligence. And so I'm a big advocate of the due diligence clause and structuring it properly to be able to allow a buyer to get out if they need to. And what this means is we're able to cut the Schedule A conditions down to just one, as opposed to having your financing, your inspection, your appraisal, your insurance, whatever it might be. Now we just have one. And because sellers have an idea what due diligence means, we can sort of write that condition to give off the impression that really what we want to do is compare what you're saying the deal is to what you can prove the deal is, right? We want utility bills for the last 24 months, and then you sit and wait until they get you 24 months worth of utility bills. And
7 weeks.
what's that?
Said 7 weeks with dealing with the city.
Right.
Yeah.
Right. But just because we crafted to say that doesn't mean it doesn't apply to absolutely everything else that we are doing due diligence on, which can include, for instance, and most apropos for this conversation, financing. And so, it doesn't work every time, but it does work. And so, if you need help drafting a due diligence clause to really get you some confidence and give you the ability to get in with a relatively clean offer that isn't littered with 3 or 4 or 5 conditions, all of which could give you an out, we cut it down to one, we write it properly, and then we submit and see what happens.
For sure.
Yeah, no, it's all about, utilizing the strengths that you have and being creative. If there's creative financing, and then if there's creative ways to write offers, taking advantage of that, anything that's going to help strengthen the deal and give you an edge, over the seller.
Definitely having a slight edge, is something that you can use to your advantage when purchasing real estate. So take advantage of every single little angle you can get.
Yep. Speaking of conditions, and we'll keep talking in terms of hot markets like this. Something that we have pain points sometimes on our side is just down payments. Making sure it is verifiable up front with the full 90-day AML. Just something for the buyers to be aware of. Every time you move that money, there does have to be an additional 90 days verification done. So if you're taking, potential TFSAs into your checking and then into your new savings account, that's 3 new sets of 90-day histories that we're most likely going to need. So just be aware of any unnecessary movement of money. The less you can move your down payment funds, the easier it's going to be. Getting nitpicky with lenders over the 90-day history. If you show them 3 months and there's some little bit of deposits that have been made from somewhere, and they're, $2,000 to $3,000, and maybe you only had $12,000, $20,000 in there. If they deem that that's a large enough percentage of that funds that were transferred, now they're going to want to have an additional 90 days. So anytime we have to show them 3 months of bank statements, it opens up the crack for the underwriter to say, well, where'd that where'd that deposit come from, or what was this? And then when we have to show them another 90 days, some underwriters are taking 24, 48 hours to get back to us on conditions and documents. Every time you got to upload something, now you look at, a week, 5-6 days of just waiting to hear back. So the less you can move the money, the better it is for us. The less documents we have to show, the smoother it is on that front. And again, that's why we ask for all the documentations up front. We know it's frustrating to some people. We get comments all the time where, hey, my last mortgage broker didn't ask me for this, or the bank didn't ask me for this. And, we get it, but we would rather have more than enough documentation up front and verify everything than, 5 days out, 3 days out, we're getting, oh, hey, the lender wants to see this again, or hey, this, or they're picking apart this. If we can get it all into them the day that we submit the deal, and right from day one, they have all the documentation, they can look at everything, they'll get back to us in 3 days, and now we have a full set of updates on the conditions, instead of just slowly piecing things together and having to wait for new conditions or updates every single time that we submit it back in. So we know it's frustrating, but there are reasons why we do it, and it does streamline the process for sure.
Yeah, and it makes the transaction easier on your end as it does on ours, which is
always a win.
Always.
And you gotta trust your professionals. You've asked us to work for you for a reason.
Yeah.
And we're in this business. We do it. We do it every day, and we do it very well. So yeah, just because your last mortgage broker didn't ask you for X, Y, and Z doesn't mean that was the right thing for that mortgage broker to do.
Yeah.
Maybe it's close for that deal, or maybe that mortgage broker isn't that good, or isn't thinking ahead, knowing full well that this isn't your traditional buy my home for the next 5 or 10 or 25 years.
Yeah.
Investors are moving at literally warp speed. I have a client who is going to do 200 deals this year. That's a lot of deals. And they're coming in with 3-week closings, with basically firm. And, you got to trust your professionals, because we can handle it. We can do it. But man, you got to work with us, because
yeah. And there's a reason that sentence goes, my last blank. Hey, if you have to explain who your last person was, there's a reason why you've moved on from that person. So maybe good. I'm not saying it ends badly, but there is a reason you've moved on to someone else. So,
yeah, we see it. I mean, we've seen it several times just since the last time the three of us spoke on a call like this. People who are investors, real estate investors, doing great things, really cool things, who are just tired of dealing with a real estate lawyer that just doesn't get it, doesn't know what wholesaling is, doesn't know what a BRRRR is, really understands how to process a transaction. As we talked about last time, processing real estate transactions, very important, but kind of basic, generally basic. It's the structuring of it. It's the understanding the nuances. It's about getting in there and helping actually make a difference. It's the same on your side. Working with a mortgage broker who helps people find a mortgage for their forever home just isn't going to cut it very likely when it comes to an investment property, especially if you're doing multiple deals or lots of deals. You got to deal with people who understand it, who get it, who work with lenders, who actually work with investors, who understand it. We have a mutual client that is tremendous with investors and offers a fantastic set of products.
Yeah.
But if you're an investor, there's a reason why you're no longer working with the last person that you worked with. So trust the people that you have chosen to go forward with.
For sure. And I think a lot of investors in general understand the concept of it, though. I have the majority of the people I do business with are they're friends. I talk to them multiple times a week, and we have conversations about what they're doing, keeping up to date on some of their projects. It's more than just a transaction, because when you're working on a goal, you have to be working all at the same pace and together. So, there are guys who I do transactions for every single month. I will close a deal or refinance a deal for them every single month, every month for the next 10 years, because they have goals and they need to accomplish those goals. But if you're working with different people and those different people aren't aligned, they don't know what you want, you're not going to be able to accomplish those goals. So, working with somebody who truly knows what they're doing and creating that partnership, it allows you to feel comfortable in closing these transactions, which is probably one of the most important things. When you meet somebody or you have a client who is stressed or is feeling anxious about the transaction, it's never a healthy thing, right? So being able to eliminate that and feel comfortable with the person you work with and truly trust the person you work with is the name of the game at the end of the day. All you want is to be able to trust people, and that they have your best interest at heart. So be careful who you work with and choose the people carefully. But those people, you should start creating those relationships with the people and really start fostering that, because that's how you're actually going to be able to accomplish what you want to accomplish.
Yeah, I mean, this in the same, for us, as a mortgage agent, to be able to close quickly and expedient, it's the same thing on a lawyer. The second thing that's going to hold up a deal that needs to close in a rush timeline is just how fast can your lawyer close the deal. And that's always the second thing we get to on these rush private deals is, can the lawyer close in this period of time? When you need to turn around in 24 hours, can you do it? Can you do 48 hours? What can your lawyer get it done? And that's, essentially the second most important piece of the puzzle is, getting the numbers together in time and the financing option, and then just being able to close it in time. We can put together the front end, but you got to have a lawyer who can wrap up the back end and get it done, in the right amount of time. So
there's so much to do as a lawyer for the buyer. Let me tell you a little bit about it. So, it's not just as simple as reviewing the agreement of purchase and sale, searching title, taking your check for your down payment, and sending a wire to the other lawyer. It's just not that simple.
So we do.
For a couple of reasons. Number one,
I see your list of conditions on those commitments. Come on, man, they're not that big.
Number one, we ask for two parties in most residential and potentially commercial real estate transactions. We have two clients, which is inherently a conflict of interest, but we're allowed to engage in this conflict of interest under the rules of professional conduct, because the process of borrowing from a non-private lender like a bank or a credit union, or in some cases mortgage investment corporations, is a relatively sophisticated process that's undertaken by a sophisticated lending client. And so the Law Society says, you know what, they know what they're doing. You can act for both of them, but there's a complication there. I act for both parties. So I've got to do what's in the best interest of both parties. And that can't mean sacrificing the interest of one for the interest of the other. And at the end of the day, what that means is there's a lot of paperwork to both prepare and have signed. In the last week, I have done at least 10 signing meetings where the signing package, the package of documents that needed to be signed was over 80 pages long.
Jeez.
So, like, can I close a deal tomorrow? Probably not, because 80 pages takes a hell of a lot of time to put together. And these aren't just standard precedent documents. Sometimes they are. But even with the precedent document, we've got to change up names of both the borrower and the lender. We've got to change up dates, prices, amounts, other conditions, etc. It's a complicated juris process. It takes time. And so, yeah, is it possible to close relatively quickly? Yes, but it takes time. And so you've got to let us know in advance, hey, this is what I'm going to be doing, because we got to get on the phone or get some email communication going with the rest of the people on your team. Get me connected with your insurance guy. Get me connected with the Finlay mortgage team. Like, let's put it all together. That cuts the process down for us on the back end, for you guys on the back end, for the insurance guy on the back end, and actually eliminates a lot of the work of the buying client. You can just connect us and we'll do the background work while you go off and find more deals.
Yep. Yeah, no, absolutely. And I mean, sometimes it's just as simple as a, quick like heads up text from us to you, like, hey, wipe away all your other clients, buddy. I got one coming in red hot, need it done for tomorrow, just some sort of heads up. And you're right. And the more you continue to work with your power team and everyone, the more they get to know each other, the better they can interact, the more efficient the process is, and the more smoother and in most cases, the quicker the closing as well too. So really is all about the community, making sure everyone's on the same page, utilizing the same people that you trust, and just, being hands off, allowing that team to do the work for you and just being hands off from it, and being able to focus on what you need to focus on as a buyer, whether it's just getting everything ready or whether it's, looking for the next deal or making sure that, your renovation team's in place. You have other things to be worrying about. Like you said, you pick your power team, you got to be able to trust in them until, they prove you otherwise, and just allow the process to happen.
Yeah, couldn't agree more.
Yeah,
for sure. Well, I think we're just going to wrap it up, guys. I mean, Sunday, I think we're 47 minutes in. Appreciate everybody obviously tuning in to all of our streams, YouTube, Facebook, Instagram. We appreciate you all tuning in. We will be back next Sunday at 6 o'clock. If you have any questions, leave them in the chat below. Hit the like up button. If you haven't, go to our YouTube, hit the subscribe button. We are trying to grow that following and push out more content this year. But thanks so much for tuning in, guys. We will see you again next week.
Cheers, guys.
See you, John.